Today, folks, if you love Canadian dividend stocks, look no farther. I'm still calling a bottom here in the Canadian telecom sector. With earnings around the corner, I thought it'd be important to provide some updates on this mission-critical infrastructure that people seem to still underappreciate, not realizing. If you go on TikTok today, if you're on Facebook or Instagram doing your ChatGPT, Gemini searches, all of that is supported and existed by the infrastructure these companies hold. And in Canada, they're monopolies. There's only a handful of players here. There is an onslaught of a new one called Quebecor we're going to discuss because it's absolutely crushing it. I think it's the owner of Freedom Mobile, but regardless, Telus is paying a 7.7% yield. This is a record high dividend yield for this company, and I just want to talk about the signs of the bottoming. Is the dividend still affordable, and so much more in between. So if you're on a path to financial independence, if one day you'd like to retire early, join me on that journey, because I just said, hey man, you can come up with $10,000, you put it in here, $10,000 investment, you're making $770 a year, which are qualified dividends, meaning you're virtually paying no tax, and that should be able to pay your phone bill and perhaps your internet in perpetuity for the rest of your life. It is such a simple investment to yield such a good result, and unfortunately timing these stocks I think is more important than cost averaging into them, because these stocks have gone through a crazy suppressed nature. A lot of people have exited them, but as somebody that primarily likes buying dips on very good companies, and we've seen this work out quite well with things like t.to in Canada. I recently did it with Google, and it's fun finding these hyper huge monopolistic like companies that get really suppressed based on media or certain cyclical cycles, and buying those dips when it makes sense. So let's dive into this a little bit deeper by first and foremost looking at what's going on in the United States. We have seen quite the recovery as of recently go on with things like Verizon that bottomed out back in 2023. And if you've been cost averaging through 2023, even into the end of 2022, it's likely that you've seen pretty healthy returns, considering the yield was closer to 7 to 8% then, and the stock is starting to rebound. But there's a lot of criticism around it as of recently. It dropped quite materially because the old CEO that recently left PayPal back in 2023 is now the CEO of Verizon, and I absolutely hate PayPal, and people aren't too fond of this because of the insane nature of the crash that PayPal went through. That CEO got ousted, left, and the stock has never really recovered since. So that's putting some fear in the eyes of why is this guy controlling this company. But I think like Warren Buffett says, even if you're a moron, you want to make sure that a company can be managed by a moron and still succeed. And Verizon has some very stable revenue, right? And the revenue is starting to rebound here. Earnings per share is a really hard metric to use on companies like this because of the depreciation and amortization costs, which we're going to see with a company like Telus. Free cash flow is a little bit more prevalent. But regardless, I think Verizon's a really interesting company too, because again, the dividend yield is higher than it's ever been throughout its entire history, and it's still pretty high overall. AT&T, what a recovery story. I mean, if you look at AT&T in the United States and you bought it anytime within the last 5 years, you've probably seen some pretty great returns, knowing that they've even cut the dividend in the past. But again, if you bought these dips, the years of suppression here, stock really rebounded in the last year, man. It is up a lot. Year to date alone, 14% plus great dividend. And again, it is correcting on similar news to what is going on with Verizon, right? But let's switch over here and let's start with Telus. We'll compare it to maybe the other telecom providers here in Canada. And again, I want to remind you, these are monopolies. There's really only 4 major players here: Telus, Bell, Rogers, and Quebecor we're going to bring up. But Telus is the main focus because if we take a look, they have probably the most stable revenues of many of the telecom providers here in Canada. If we take a look at the other metrics like that dividend yield, I'm telling you guys, the highest dividend yield pretty much in the entire history of this company, with the exception of maybe the '08 financial crisis that really drove the stock down. But if we take a deeper look into it here, what I find most interesting over all the other telecom providers is it's not focused on media and entertainment. Rogers, I'm sure you've seen the Rogers Center. They own a lot of the sporting channels. Bell owns Crave. And I hate media. Outside of YouTube, I get it, Netflix is crushing right now, but YouTube has the most superior, entertainment media where they're not paying for any of that content. They do a good ad revenue share program. People want to aspire to be YouTube stars. I don't hear too many kids want to like get into Netflix and be big actors on Netflix. Like, they all want to be YouTube stars, right? So I figure that's the place where I want to focus my media dollars and my investment dollars toward media and entertainment. So I don't want it out of the telecom providers because it's quite a cyclical business. It costs a lot. But when it comes to this company, guess what we have? We have one of the most important nuances in healthcare, which is telehealth. Getting access to doctors in a country where sometimes it's hard to get family doctors, get in offices quick, and they've gone from 75 million lives covered to 157 million, adding over 100 million within a year. I can't get over that, guys. And even on the back of a slowing immigration story, because the government's cutting off a lot of immigration year over year from 19.5 million to 20.4 million active connected. I mean, this is crazy, right? Like crazy telecom subscriber growth, all things considered. So these are the two aspects of the business that I like the most going on right now. And I know a lot of people are kind of telling themselves is that they look at the dividend payout ratio, which goes to the earnings per share, it looks completely unsustainable and unaffordable, but it's not. We can see that the actual free cash flow expectations, approximately 2.15 billion. And even if you take some effort, you go on to Gemini, ChatGPT, Llama, and you ask them, like, is the dividend sustainable? It says the company's dividend payout ratio is 247% based on trailing 12-month earnings and 205% based on cash flow. Although these ratios might seem high, Telus's free cash flow target for 2025 is 2.15 billion, which exceeds its dividend payout of 1.66 billion, meaning that the dividend payout is sustainable of a ratio of 77%. You got to consider the depreciation and amortization costs. And I keep telling you this because that's money that the company is still making. But the only way I can explain it to noobs out there is, let's say you go and buy a car, right? Outright with cash, you go buy a $50,000 car and it immediately loses 15% of its value. Well, next year, I can write off that 15% loss in value against the cash flow that car is generating me at my job. I mean, nothing's changed. I didn't spend more for the car next year, but I'm able to write the taxes off against that cash flow. And that shows up on the EPS as basically saying it's void. It doesn't show up on the earnings per share because I'm not paying tax on it. The government's waiving it as a loss, right? So that's how these companies kind of operate. And it's good to pay attention to that. But look at Rogers as an example. Here's another company that really found its bottom this year. I mean, look at it. It's trading up 11%. Great starting yield here at 4%. Obviously not nearly as high as the likes of Telus, but we've seen it on the back of a deteriorating, earnings period or revenue period. I mean, the revenue has slowly been declining. If you take a look at the earnings per share here, it's also been declining. I'm really shocked at how this company, has been turning it around a little bit. The recent earnings weren't terrible, but I mean, Rogers has, I think, found its bottom here more than likely. I mean, you can take a look here and see that like the net income was down, revenue was up slightly apparently, but yeah, earnings were down, net profit. I mean, we got to dive into this a little bit deeper when earnings come back and take a look at what's causing some of this. Bell, another stock here that's starting to trade up. It's flat on the year. It was starting to trade into the green, but it is trading down a little bit, 5.41% yield. I think Bell probably a little more favorable here, but again, it's not been my favorite. Again, declining revenue, earnings per share has been quite volatile here. I mean, the company's on this turnaround phase after massive restructuring, dividend cuts, all that. A lot of people are looking at the motley fool. Is it time to ditch BCE stock for this incredible dividend play? Everyone's people have really given up on Bell, but this is why I like this sector so much, because again, it reminds me of t.to, it reminds me of Google, these sectors that people are just crapping on relentlessly, but we're still seeing some growth. Look at Quebecor, up 3.13, or the dividend's 1.13%. It's been probably the best growth story in the telecom space, up 41% year to date. The company has seen some pretty reasonable revenue growth, but what's really driving a lot of this is the efficiencies. They've been cutting some cost here, so their cost of revenue has been going down, driving up their gross profit and their earnings. So this company is just proving that there are a lot of capabilities in the space. And another reason that I like Telus so much is they are supporting AI data centers here in Canada. They do have some foothold with new AI centers that are going up. So I think, again, I know a lot of people. You can talk about it any way you want. I get it. If you were in this stock prior, you've been getting absolutely slaughtered. But again, timing individual stocks matters a lot. The value you pay for individual stocks matter a lot. I mean, finding mega cap companies around the world that have potential that you understand. I mean, look at Alibaba, right? Like, a lot of people gave up on this company after it cratered. But I mean, if you cost averaged into it once it cratered, you've done pretty well. I mean, in a couple years, you've seen 100% gain. You got to find these sectors that you think you understand that are completely suppressed, guys, and play them out how you will. And I'd love to know if you own Telus here. I obviously get my exposure through VDY. If you're buying XCI, any of these Canadian dividend stocks, you're naturally getting some weighting there. But I think as an individual play, if you're somebody that just wants to lock in a high yield in retirement, I think you can make it a small percentage of your portfolio. Not as financial advice. These, of course, are opinions of my own, and we'll see what earnings bring in. But something tells me they're going to start doing a lot better here with the lower interest rates. They've gone through the restructuring phases, so it'll be neat to see what happens. But I'd love to know what you think in that comment section below.